Hi, welcome back to this, my second data update for 2021. In this session, I'd like to talk about a metric that I call the price of risk. Now, when investors look at markets, they're constantly on a search for a single metric, a number they can focus on that will tell them whether stocks are overvalued or undervalued. For decades, the ratio that people have used to judge markets is the PE ratio. In recent years, that's been adapted and modified with inflation-adjusted earnings or normalized earnings, but it's still a PE ratio. The problem, of course, with the PE ratio is for much of the last decade, it's told you stocks are overvalued. In fact, you'd have been out of a decade when stocks were up significantly if you track the PE ratio. And the failure of that ratio has been attributed to lots of different reasons. Some argue it's because interest rates are low and they blame the Fed for this. Some think it's because we're mismeasuring earnings, especially at technology companies. And some attribute it to just animal spirits and the market has just gone crazy. In this post and session, I'd like to offer you an alternative to PE ratios. A number I think captures more of what's going on in the market, brings in rates, brings in growth, brings in risk. And that metric is the price of risk. You're probably saying, what the heck is the price of risk? Let me set the table. When you're an investor investing in a risky asset, here's how you build up to an expected return. You start with what you would make on a guaranteed investment, a risk-free rate. And then on top of that, you attach a premium. And that premium will reflect what you demand as an additional return for investing in the risky asset. Now, how big should that premium be? It'll be a function of A, how risk averse you are as a person, with the premium increasing with your risk aversion. And second, how much risk you perceive in the investment, with the premium increasing with the amount of risk you perceive. Now, that is the opening I'm going to use to make a judgment on markets. Now, before we look at specific measures of risk premiums, there are three things I want to put on the table. The first is you can observe the premium that investors are demanding. You know how? By looking at what they pay for something. The most revealing factor in what your risk premium is what you're willing to pay. I can back up from the price of an asset what your expected risk premium is. Second, that risk premium can and should change over time. Why? Because how risk averse we are varies across populations, across time, across different geographies. That should be factored in. And third, when risk premiums change, the prices of risky assets will change in an obvious way. When I demand a higher risk premium, I have to pay a lower price. In fact, risk premiums and prices move in opposite directions. Now, before you go off on this is all theory or abstraction, remember nothing I've said so far makes a judgment on what the risk premium should be. I'm completely open to the possibility that the risk premium you observe could reflect a risk aversion that's not there. Risk neutral investors, in which case your risk premium could be zero. I'm not passing judgment on what a high number is or what a low number is. I'm just going to let the market tell me, or investors collectively tell me, what the price of risk is. So let's get started. Let's start with the bond market. In the bond market, bond prices are volatile even if the cash flows are guaranteed. Why? Because interest rates change. When interest rates change, the price of a bond changes. But if you take that part out of the equation, there's a second element of risk on bonds which are not guaranteed. There's a default risk. And the way we measure the price of risk in the bond market is with a default spread. The difference in what interest rate you would charge for a risk-free bond and an otherwise similar bond with default risk in it. Now, the way we measure what you demand on a bond is by looking at the yield. That's an easy measure, but a slightly messier but a more complete measure is the yield to maturity. What is the yield to maturity? Basically, if you have the price of a bond and you have the expected cash flows on the bond, which would be coupons and the face value, the yield to maturity is that discount rate that makes the present value of the cash flows of the bond equal to the price of the bond today. The yield to maturity is an internal rate of return for a bond. So the yield to maturity of a corporate bond is 6%, and the yield to maturity of an otherwise equivalent treasury bond, same maturity, same coupon, is 3%. That difference is the default spread. Now, if you build on that proposition, you can actually measure what the default spreads are fairly simply because bonds are traded, we can observe the prices and the yields to maturity. In this graph, I've looked at the default spreads at the start of 2021 for bonds in different ratings classes. I'm using S&P and Moody's ratings as my way of classifying bonds based on default risk. The good news here for the ratings agencies is, roughly speaking, that default risk measures seem to work because the lower the rating, the higher the spread. So we look at a typical triple B rated bond. At the end of 2021, the default spread was slightly less than 2%. Sorry, at the end of 2020. Now, if you compare the default spreads at the end of 2020 to the end of 2019, it doesn't look like much happened in 2020. And that would be deceptive. Because 2020 was a roller coaster ride for default spreads. Why? Because you had COVID, a crisis, a market shutdown. And basically what you see in this graph is how default spreads went over the course of the year. Take a look at what default spreads did, especially between February 14th and March 20th. Across the board, in every single ratings class, default spreads almost tripled. That is almost unheard of. The default spread in a triple B bond went from 1.33% to 3.73%. That's big news. But the even bigger news is what's happened to spreads since March 20th. They've gone back to where they were before the crisis. You might say that makes no sense. We're in a crisis. Shouldn't the spreads be higher? Well, I'll give you one way in which you can make that judgment. You can compare default spreads now. You can see that in the shaded line towards the bottom, towards default spreads in the past. Default spreads currently are slightly lower than the median spread. Historically, they're at the low end of the spectrum. Now, one reason you might worry is if you're in a crisis, even if the market has gone through the crisis, the risk of default has stayed high. So another way in which you can measure the adequacy of default spreads is to compare them to the actual corporate default rates. So if you look at this table, you actually have the default spread in the black line. The red line are the actual default rates across companies as a percentage of loans outstanding. Notice the two tend to kind of move together. The default spreads lead the actual default rates. One of the interesting things is the default spread jumped in the middle of the year. The default rate in 2020 went up. But at the end of 2020, what markets seem to be saying is the worst is behind us, that default rates are going to subside back to where they were before the crisis. We're going to find out whether that's a reasonable assumption. But that's the price of risk in the bond market. You say, what about the equity market? Just as in the bond market, there's a price of risk in the equity market. We give that price of risk a name. It's called the equity risk premium. But here's the catch. It's much more difficult to observe and estimate in the bond market than in the equity market than in the bond market for a simple reason. On a bond, the cash flows are given. The coupon rate is given. Of course, there can be default, but the coupon rate is specified. When you invest in equities, your cash flows are not a given. They're not guaranteed. There's not a contractual claim. They're expected cash flows. Can they be estimated? I think so, but they need to be estimated. But for many people, this challenge of not being observing equity risk premiums has led them down a different path. The way most analysts, most appraisers, most investors think about equity risk premiums is by looking backwards, looking at history and asking, over the last 20 years, over the last 50 years, over the last 100 years, how much of a premium would I have earned investing in stocks as opposed to something risk-free? I don't like historical risk premiums, but I do update them on my website at the start of every year. So if I brought in the 2020 numbers into my data set, here's what the historical risk premiums look like in the US. Now I know this graph looks like an incredible mess, but there are three lines in this graph. The first is returns on stocks, the most volatile line. The second is returns on T-bonds, more volatile than less volatile than stocks because you don't have the other dimensions, but still volatile because as interest rates change, it moves. And the rate on T-bills, which is a pretty stable line, the return on T-bills. If I look across, for instance, the entire time period, 1928 through 2020, stocks have earned an average return, if you look at the compounded average, about 4.84% more than T-bonds have delivered over the period. So over the 1928 to 2020 time period, stocks have earned a historical risk premium of 4.84%. Now, we're often told that decimals create false precision. 4.84% sounds awfully precise. But here's what I should add. These numbers are noisy. There's a big standard error in them. In fact, the standard error on my risk premium is about 2.2%. You're saying, what does that mean? My true risk premium in the US could be as low as 0.6%, as low as 0.4%. That's 4.8% minus 2 standard errors, or as high as 9.6%. That's a pretty wide range. Now do you see why I don't like historical risk premiums? Not only is it backward looking, not only is it noisy, but it is also built on the premise that the future is going to look like the past. Now, if you're a believer in mean reversion, you might pick a number, but notice the number you pick will reflect the choices you make about estimation periods, what you choose as a risk-free rate, and even how you compute your average. So I'm going to offer you an alternative. Rather than look backwards, why not look forwards? Why not estimate an equity risk premium based on what people are paying for stocks? And in a sense, I'm going to draw on the yield to maturity calculation you saw for bonds. Remember how I computed the yield to maturity for a bond? I took the price of the bond, the promised cash flows, and I solved for an internal rate of return. I'm going to do the same thing on stocks. I take the level of the index, I get expected cash flows in stocks, and these won't be coupons, it'll be dividends and buybacks. That'll require judgment call and estimates. And unlike a bond, which is a finite maturity, stocks continue in perpetuity. So I'm going to make some assumption of what happens to cash flows after I stop estimating them. And finally, I'm going to look for an internal rate of return that makes the present value of my expected cash flows in stocks equal to the level of the index. That's my expected return on stocks. If I net out the risk-free rate today, I get an equity risk premium. I can do this for pretty much any index where I can estimate cash flows. Now, the index I do this on most frequently is the S&P 500. In fact, I do it at the start of every month at the minimum. At the start of 2021, here's what the implied equity risk premium looked like for the S&P 500. Let's set the table. We're coming off a fairly awful 12 months in terms of earnings for the index. The index earnings dropped. Why? Obviously because of the COVID shutdown. What I've used as my projections are numbers based on the premise that we will come back. I'm building it loosely of what analysts are projecting in earnings for the S&P 500 going forward. But if you look at the earnings I'm projecting for 2021 and 2022, I'm still well below 2019 earnings. So I project out earnings. I've smoothed out the growth rate to make my life simple. I mean, you could actually use the actual consensus estimates and you get a slightly higher implied equity risk premium. I've just tried to keep my life simple. So the first big input here is earnings in the future. Second big input is what percentage of these earnings will be paid out in cash flows. That's what you see as expected dividends and buybacks. And notice that that number is smoothed out over time. It was, in fact, higher than 100% last year, but it's going to smooth out over time. So if you get the projected cash flows and the level of the index, and you look for the discount rate that makes the present value of the cash flows equal to the level of the index, and notice after year 5, after 2025, I'm expecting cash flows to grow at 0.93% a year forever, which is my risk-free rate. My risk-free rate is a rough proxy for nominal growth. The internal rate of return I get for stocks is 5.65%. You think, what does that mean? Given what investors are paying for stocks at the start of 2021, they can expect to earn 5.65% from the cash flows. If I subtract out the T-bond rate, that should be 1,121, not 1,120. That's a typo. I get an equity risk premium of 4.72%. That was my equity risk premium at the start of 2021. Now again, 2020 was an extraordinary roller coaster ride for the equity risk premium. In fact, I computed the equity risk premium for the S&P 500 every day in 2020 because it's one way I cope with crises is to get a sense of reality and get my perspective back. And you can see between February 14th and March 20th that risk premium rose from 4.8% to almost 7.75%. That's what markets do in a crisis. People are afraid. But again, the story here is how quickly risk premiums have reverted back to where they were before the crisis. So as with default spreads, we're seeing this very quick reversion in risk premiums to where they were before the crisis. They're saying, so what? I'm going to argue, especially as you hear talk about market bubbles, the market in need of a correction, I'm going to argue that every question you have about the market can actually be reframed as a question about the implied equity risk premium. If you believe the equity risk premium is too low, you're telling me stocks are too high. If you tell me the equity risk premium is too high, you're telling me stocks are undervalued. Or framed differently, if you accept my computation of a 4.7% premium, the question I'm asking you, do you think that equity risk premium is too low, too high, or just right? Now you're saying, how do I make that judgment? Well, one way is to look at history of the equity risk premium. I've computed the implied equity risk premium at the start of every year going back to 1960. The average over the last 60 years is 4.2%. Well, 4.72% is high. I think that's pretty good. Well, relative to the last decade, though, we are looking at a lower risk premium. You can already see why there's room for disagreement in the risk premium. But there is a more troubling number I want to bring you back to. While the risk premium by itself doesn't look outlandish or too low, and in contrast, think about what the risk premium looked like at the end of 1999. 2%, that was a low number. We're not facing that scenario. There is another number which is a little more troubling. Remember, the equity risk premium 4.72% is on top of a risk-free rate of 0.93%, which means my total return is 5.65%. If I look at that return relative to history, that's an outlier. Even over the last decade of low interest rates, the market has been delivering about a 7.7% return, the expected return. Over the last 20 years, it's been about 8%. If I go back in time, it's about 10%. Today, the market is priced to earn 5.65%. Now, it's one of the things that is troubling about the market. The question is, what's keeping it low? And the answer is, it's not the equity risk premium being low, it's a risk-free rate. So now what? This framework that I've just given you for looking at the price of risk can be flipped around to value the index. And to value a market, you got to make judgments on four things. The first is expected earnings in the future. You make your best estimates. What percentage of those earnings will be returned in cash flows? What will happen to the risk-free rate over time? And what's an acceptable ERP? If you can do that, you can value the index. So you know what? I'll go first. I'll make my valuation of the index in January 1st, 2021, and then I'm going to turn it over to you to make your own judgment. So don't worry too much about what you think is wrong with my assumptions. Make your best assumptions. So I'm going to value the index on January 1st, 2021. And to do this, I need expected earnings. And I'm going to outsource that, at least for the first 2 years, to analysts projecting earnings. I know analysts could be biased, but these are earnings for the entire index. And the analysts we're focusing on have tended to be relatively close to the actual numbers. They overshoot or undershoot, but there's no systematic bias in this collective number. And they're projecting earnings of 169.18 in 2021 and 197 in 2022. Okay. Beyond 2022, I set the growth in earnings to whatever the risk-free rate is, arguing again that nominal growth and risk-free rates tend to converge. What about the risk-free rate? I do believe risk-free rates will rise gradually over time, partly because I think earnings are going to come back, and that requires a healthier economy, which is going to push up rates, but it's going to come up gradually from 1% over time to 2%. So over time, my required return will go up. And for my required return, I'm going to build in a 5% equity risk premium, higher than my historic norm, but lower than this 10-year average of what I call a crisis market. Now for the payout, I'm going to allow 75% of the earnings to be paid out in the form of dividends and buybacks. That's well below what it was in 2019, where it was almost 94%, or the 88% 10-year average. But I think companies are scared. The crisis scared them enough that they will lower cash flows. But over time, that cash payout will rise. To what number? Well, in my end game, in my final year, 2026, my growth rate is 2%. And I have about a 16% return on equity that I've computed for the S&P 500. With those two numbers, I can back out how much of the earnings should be paid out. I call that a sustainable payout ratio. It's about 87.65%. So over time, my payout ratio changes. I know a lot of complex pieces, but I'm projecting cash flows based on my earnings and my payout ratio, and a required return based on my risk-free rate, my risk premium. I compute a present value of my cash flows. I come up with 3,360. On January 1st of 2021, I'd have valued the index at about 12%. So basically, my judgment on value at about 12% below the index level. I think it's overvalued. But don't make my judgment yours. In fact, to show you the different scenarios that can unfold, I'm going to argue you're going to have to make judgments on what will happen to the economy, whether it'll be strong or weak, and what will happen to interest rates. And I have three scenarios here. Interest rates stay at 1%, they rise gradually to 2%, or they rise quickly to 2%. The economy is strong and the economy is weak. Let's take what I call my Goldilocks market, where interest rates stay low. Earnings are actually above analyst expectations for the next 2 years, and the equity risk premium drifts back to historic norms, close to 4.2%. Well, then the market is actually undervalued by almost 20%. So if you're bullish, you're believing the Goldilocks market. The one catch here is, how do interest rates stay at 1%? The economy is coming back gangbusters. So with this scenario, you got to trust the Fed to have so much power that it can keep rates at whatever it wants them to be. In all of the other 5 scenarios, the market is overvalued. But the amount of overvaluation depends on A, whether you think rates will rise gradually or quickly, and how strong or weak the economy. In fact, in the extreme scenario, meltdown market, if rates rise quickly, earnings come in below expectations because the economy is doing badly and equity risk premiums rise to crisis levels, the market is overvalued by almost 39%. I'm not trying to have my cake and eat it too. I do think the market is overvalued, but I think it's overvalued closer to 10 than 40%. And as many of you know, if you've read my posts, I'm a reluctant market timer. I don't like to time markets, but we're all market timers. Some of us do it implicitly based on how much cash we hold in our portfolios or non-equity investments. Others do it explicitly by actually buying protection or betting against market moves. Coming into 2021, I'll give away where I am. I have far more cash in my portfolio than I usually do. And I have actually bought some market protection. Not complete protection, I haven't gone crazy. But I've used index puts to protect myself at least partially against a big drop. Now, I'm not telling you should do this. I'm not an investment advisor. I don't want to be one. Here's what I'd like you to do. The spreadsheet I use to value the index, you can download it. You can make your own judgments and make your actions consistent with your own judgments. That is the healthiest way to approach investing. Thank you very much for listening, and I hope to see you soon.